Hello and welcome to AE Accounting Tutorials. We are continuing our lesson on accounting for branches with a special focus on autonomous branch, what I called independent branch. This autonomous branch has been a headache for most students, and I want to simplify everything on this channel. In this lesson, I want us to learn how to prepare the financial statement of autonomous branch. These financial statements are the autonomous branch trading profit and loss account, that is the income statement, and autonomous branch balance sheet, that is the statement of financial position. So if you haven't subscribed to this channel, I will encourage you to kindly subscribe to this channel and be part of our YouTube community. So before we look at the format of the autonomous branch trading profit and loss account, that is the income statement, I think it is very prudent for me to introduce you to the basic concepts of the autonomous branch. So when we talk about autonomous branch are independent branch, a separate entity branch that prepares their own set of books. They are capable of preparing their own trading profit and loss accounts and balance sheets. Unlike dependent branch that the head office needs to prepare all books or prepares all accounts on their behalf, they are capable of preparing their own set of books. That is, they have to go through the accounting process by identifying and analyzing their branch transaction, by recording them in the journals, then post them to the ledgers, and after that they prepare or they extract their own trial balance. So in practice, they are capable of preparing their own trading profit and loss account and balance sheets from the trial balance they have extracted. But for the purpose of examination, after they have prepared their trial balance, then they send the trial balance to the head office. The head office will, based on the trial balance prepared by the branch, to prepare the autonomous branch trading profit and loss account and balance sheets. One thing I want you to also take note is that when goods are transferred from the head office to the branch, instead of the branch to make payment for each consignment, they maintain two current accounts in order to record the indebtedness of the goods transferred. In the book of the head office, they maintain what we call branch current account. Okay, at the end of the period, they are able to determine the net investment or the assets they have invested in the branch, and we will look at how to prepare that subsequently. And in the perspective of the branch, they also maintain what we call head office current account, and this current account represents a liability account to the branch, and that is that. So subsequently, we will look at how to prepare these two current accounts when we are looking at the autonomous branch statement of financial position or balance sheets. So let's quickly look at the format of the autonomous branch trading profit and loss account or the income statement. So let's look at that. So trading profit and loss account for the year ended. So the year in which you are preparing your accounts, you bring that particular year. Now, because it is a combined income statement for the autonomous branch, we have to prepare it in a columnar form by having a column for the head office, HO means head office, a column for the branch, and the combined trading profit and loss accounts. So for instance, if you have sales under head office, sales under branch, we add the two, then we have the combined. I hope this is clear. So for a trading profit and loss account or income statement, we aimed at ascertaining a net profit or loss. So to ascertain a net profit or loss, we have our sales revenue, then we subtract our costs of sales, or we less our cost of sales. Then when we do that, we will have gross profit or loss. So let's say gross profit. Then we subtract our operating expenses. So if we subtract our operating expenses, we either ascertain a net profit or loss. So basically, this is what this account aimed for. But it is just that we are preparing it for both the head office, the branch, and the combined. So we call it a combined autonomous branch trading profit and loss account or income statement. So to begin preparing the income statement we know of, we begin with our sales, because we want to compare the sales revenue against the cost of sales. So if the head office makes sales, we record that. If the branch also makes sales, we record that. The total of the two give us the combined sales of the autonomous branch. I hope this is clear. If it is a normal trading profit and loss account for a sole traders, we will consider a return inwards. But all returns of goods will be captured in what we call the current account. And we will look at that in a subsequent video when we are preparing or we are looking at the format of the autonomous statement of financial position or the balance sheet. So what we are saying is that all returns will be captured in there. One other thing I would like to talk about is goods sent to branch. Wherever goods are sent from the head office to the branch, the head office consider that goods sent to branch as sales because the branch is a separate entity. I hope this is clear. So the goods sent to branch form part of the sales to the head office. So we have goods transferred to branch. Goods transferred to branch by the head office. So goods transferred to the branch is considered as sales to the head office. I hope this is clear. Now, to the branch, this is considered as purchases, not sales. When goods are transferred from the head office to branch, the head office consider that as sales. But to the branch, it's considered that as purchases. So whenever we get to purchases, we record this amount. But sometimes there are differences and we will look at that. So we have nothing here, then we have nothing here. One key thing I want you to take note is that in preparing the autonomous branch trading profit and loss account, we are preparing it in a columnar form. If an item comes under head office and branch, we add and add the combined. If an item comes under only one and it does not affect the other, the combined to it will not affect. I hope this is clear. So we add this, we record this. So after that, then now we consider the cost of sales. So we said less cost of sales. Less cost of sales. In lessing the cost of sales, we begin with opening inventory. You see, when we are in business, for instance, in this 2024, we are operating a business. At the end of the period, some of the inventories or the goods may be left over, and we call that closing inventory. So in 2025, we call those inventory opening inventory, and they are the very goods that we are to sell to our customers. So the costs associated with those closing inventory that are brought to the subsequent year as opening inventory, we have to capture their costs to match it against the sales revenue. So we begin with what? Opening inventory. So opening inventory, we will capture that over here. Then we capture it and capture the total as well. But one thing I want you to take note is that inventories are recorded at cost, or they are measured at lower of cost, not selling price. Sometimes the goods are transferred from the head office to the branch at selling price. So when this happened, the profit margin on the inventory needs to be taken off. For instance, the goods are transferred at selling price and the cost is what? 1,000. There is a markup or a profit component of, let's say, 10%. Inventories are measured at lower of cost. If that is the case, we have to work the profit component, and this will give us what? 100 cedis. When we subtract 100 cedis, we will get 900. In recording, we will record the 1,000 here. We record the cost also here. But in getting the combined opening inventory, we don't add the 1,000, but rather we add the 900 because inventories are measured at lower of cost according to IAS2. I hope this is clear. So if let's say we have here to be 1,200, then here will be 1,000. This and this will give us 2,200. But don't use the 1,000, use the 900 and add it to this. And this will give us 2,100 because inventories are measured at lower of cost according to IAS2. I hope this concept is very clear. After recording the opening inventory might not be enough to meet your customers' demand. So they could have purchases. So whenever there is purchases, we add the purchases as we do for trading profit and loss for sole traders. So the purchases, we have to add it. This purchases here is an external purchases that the head office permits the branch to make. I hope this is clear. But I told you that goods transferred to branch as considered as sales to head office, this same amount will be considered as purchases to that of the branch. So this will be goods received from head office. So goods received from HO means head office. Goods received from head office will be considered as purchase. So it has to form part of the purchase. We have to add it to purchases. So we record it here as purchases. It does not affect this, meaning it will not affect the total. But sometimes it means that this value need to be the same as that of this value, but sometimes they are not the same. Just because, let's say the head office has transferred a goods or inventory value 2,000, but the branch has received, let's say, 1,800. There is a difference of 200. This 200, we call that goods in transit. Because of goods in transit, sometimes these values might not be the same. And there are ways we account for goods in transit, and we look at that subsequently. So after recording the goods received from head office, we just have to add, make additions. And we call this COGAPs. I call this COGAPs, cost of goods available for sale. These are the goods that are available for both the head office and the branch to sell to their customers. I hope this is clear. You just have to add the two and get a combined cost of goods available for sale. After getting this, we less closing inventory. So we call it less closing inventory. Listen, you see, on these purchases, we did not record return outwards. I hope you see that. And this return outwards, all those returns, I said it will be captured in the current account. So that is that. So when there are return of goods, don't bring it here. That will be captured in the current account. And the current account will be recorded in the statement of financial position. You will look at that. So the closing inventory, you will record the cost. So, because it is the head office that is transferring the goods, obviously we will have the cost. But for that of the branch, if the goods are transferred at cost, you are good to go. You have to record it as such. But if the goods are recorded or transferred as selling price, then this closing inventory, in recording it, you record the cost. I hope this is clear. All right. So you add the total. So the opening inventory, you record this at cost, this at cost. The reason is that if these goods are transferred at selling price and there is a remaining balance at the close of the period, there would be an unrealized profit on this closing inventory. There would be a profit margin on this closing inventory that the head office has not yet realized. Because of that, we have to calculate provision for unrealized profits, then we subtract it out. So if the closing inventory is 1,000 and we calculate provision for unrealized profit and we had, let's say, 200, although we will record the 1,000 here, but in adding it to this cost to get this, we will not use the 1,000, we use the 800, which is the cost. Goods or inventories are valued at lower of cost or net realizable value. So we don't have to recognize this closing inventory on at selling price, but rather on cost. So after subtracting the closing inventory, we will have what we call the cost of sales. We are now looking for this cost of sales. So I call this cost of sales. Cost of sales. So I call this figure A, then I call the cost of sales B. So when we subtract this cost of sales from the A, we will arrive at a figure called the gross profit. So gross profit. So gross profit is A minus B. Then I call this one the C. I hope this is clear. After arriving at the gross profit of the autonomous branch, then we have to consider other income. So if there are other income, you add them. So example of other income under autonomous branch could be a decrease in provision for unrealized profits. So from the trial balance, there could be a provision for unrealized profit of, let's say, 200. So I told you that we have to work a provision for unrealized profit on the closing inventory and probably goods in transit. So when we worked that and we had, let's say, 150 as the current provision for unrealized profit, the difference here is 50. This is a decrease in provision for unrealized profit, a decrease from 200 to 150. This value, this decrease in provision for unrealized profit, we record that as an income. So whenever there is a decrease in provision for unrealized profit, you record that as an income. And this does not affect the branch, neither the combined, because it is unrealized profit, or it is a profit that the head office needs to make, but the head office did not. And the head office has made initial provision for that. So if there is a decrease in provision for unrealized profits, that, as we consider it as an income, supposed to affect only the head office. And now we have something we call inventory adjustment account. So inventory adjustment account. It will be recorded here. It will not affect this. It will not affect this. Now we add and get a total. This will be the total gross profits. Now, this inventory adjustment account, we've explained this in a previous video where I said that inventory adjustment account keep records of the profit component on the goods transferred. So if the goods are transferred from the head office to the branch at selling price, the markup or the profit component that is added to the cost before we arrive at selling price, we take off all those profit components and record it in inventory adjustment account. If there are return of goods, the profit component, we take it off and record it in inventory adjustment account. At the close of the period, that helps us to determine the profit or loss on the branch transaction. So if you find out that the credit side is bigger than the debit, it means we will have a difference at the debit side of inventory adjustment account. That difference we recorded at the debit side, we named that profit and loss. So it means we have to credit the profit and loss account to complete the corresponding entry. That is why we have it here as an income. So in the inventory adjustment account, if the difference is found at the debit side, the difference should be considered as an income. On the other hand, if the difference happens to be at the credit side, that will be considered as an expense. That is when the debit is bigger than the credit and we have a difference at the credit side. We name that profit and loss, meaning we have to debit the profit and loss account. I hope this is clear. The same apply to a provision for unrealized profits. So after getting this, what we have to look at is operating expense. Now we had our gross profit, probably the total gross profit over here. Then I call this, let's say, D. So now let's subtract the operating expense and get a net profit or loss. This is very simple. So we still have to maintain our head office, HO. We have the branch. We have the combined. I bring my currency sign, dollars. I underline. Now, whenever there is an increase in provision for unrealized profits in an autonomous branch, we consider that as an expense. An increase in provision for unrealized profits is when in the trial balance, let's say we have 100 as a provision for unrealized profit, $100. When we calculate provision for unrealized profits on the closing inventory and probably goods in transit, we had, let's say, 160. there has been an increase of 60. And this 60 is an increase in provision for unrealized profits. And this increase in provision for unrealized profits of 60 is considered as an expense. So if there is an increase in provision for unrealized profits, we consider that as an expense, and it affects only the head office. I explained this to you. And this provision for unrealized profit will be found at the debit side of this account. So that is inventory adjustment account. So another inventory adjustment account, but this time it will be found at the credit side. If the difference is found at the credit side of inventory adjustment account, we have to debit the profit and loss account. So that will be an expense. It will not affect this. I hope this is clear. We could have, let's say, general expenses. Okay, it will affect both the head office, the branch, so we have to record it under the combined. Let's say we have administrative expense. It will affect both the head office and the branch, so it will affect the combined as well. Let's say we have selling and distribution expense. It will affect the head office, this, and the combined. I hope this is clear. Let's say we have finance cost or charge. This finance cost or charge could be, let's say, interest on loan and others. The head office could incur such an expense. The branch could have incurred the same expense. So that is why we record it under both branch and head office. Let's say we have a depreciation of non-current assets. So it will affect. Then we bring the total. We have so many methods of calculating depreciation. Okay, so we've looked at that in our previous video where we look at straight line method, reducing some of years they get revaluation. You can watch my previous video on that to understand the concept of depreciation. So after getting the total expense, then we have to record the total expense. So total expense, if this is D, then let me call total expense as E. So this is total expenses. Now, the total expense as E will be subtracted from total gross profit of D. So that will give us either a net profit or loss. So this will be D minus E, and I'll call it F. So this will represent the net profit or loss. Double underline means we are done. So if the total profit is higher than the total expense, we have a net profit. If the total expense is higher than the total income or gross profit, we had a net loss. So basically, this is the format of the autonomous branch trading profit and loss account or income statement. In a subsequent video, we will look at the format of autonomous branch balance sheet or statement of financial position, where we have to consider the current account, that is the branch current account, in the perspective of the head office as an asset, then the head office current account in the perspective of the branch as a liability. So we look at the format and take a full practice question to solve to enhance our understanding on questions on autonomous branch. So if you haven't subscribed to this channel, I will encourage you to kindly subscribe. You turn on your notification bell so that any moment I upload in any video, you'll get notified on your devices. So see you in my next video.